Hey, this is Franco, and you are listening to Compound Money Quietly, the CMQ Investing podcast. CMQ investors, welcome to the show. It's great to have you here. If it wasn't for Jack Bogle, I don't think I would fully appreciate just how important it is to get the costs of investing under control. What I'm about to read to you comes from a somewhat obscure keynote speech that Bogle gave in 2005. When I first read this, I'd say it was eye-opening, mind-blowing, and just like most of Bogle's advice, I'm doing better because of it. Earning your fair share of the market returns. Why is that important? Because very few investors come anywhere near earning the returns that the stock market delivers. For example, a leading pension fund consultant estimates that over 50 years, only 4% of investors can outpace the stock market itself. Why is it so difficult to capture the market's returns? Because the market returns we read about ignore the costs of investing. In the search for the holy grail of superior returns, real-life investors incur heavy costs: fund management fees, operating costs, brokerage commissions, sales loads, transaction costs, fees to advisors, out-of-pocket charges, and so on. Performance comes and goes, but costs roll on forever. Please don't be surprised at this revelation. Consider that all investors, as a group, must earn the average return of the market before costs. Therefore, beating the market, like beating the casino, is a zero-sum game, but only until the croupier take is deducted. After the deduction of costs, beating the market, like beating the casino, is a loser's game. There are two completely different kinds of costs that get in the way of your ability to earn your fair share of market returns. Stock funds incur substantial costs of operation. If a mutual fund charges an annual expense ratio of 1.5% per year and carries a 5% sales charge, such a cost, however, ignores the cost of the fund's portfolio turnover, which, while universally undisclosed, can add another 0.5% to 1.5% to those direct costs. So total direct costs, to be generous, run about 2% to 3% of your assets each year. Now, perhaps mutual fund managers are so smart that they'll beat all those investors out there and outpace the market by an amount sufficient to offset those costs. Use your head. As the trained, experienced investment professionals employed by the industry's management companies compete with one another to pick the best stocks, their results average out. The average manager, it turns out, is, well, average. Thus, equity mutual funds as a group should earn the market's return before costs. But given those costs of 2 to 3% per year, we should expect them to lag the market's return by that amount. And they do. During the period 1984 through 2004, the average fund lagged the market by 3.1 percentage points per year, while the U.S. stock market, as measured by the S&P 500 stock index, provided an annual rate of return of 13%. The return on the average equity mutual fund was 9.9%. That gap may seem small, but when the returns are compounded, the gap reaches stunning proportions. An initial investment of $10,000, simply invested in the stock market in 1984, would have produced a profit of $105,200 20 years later. The profit on the same investment, made in the average mutual fund, would have come to just $56,100. So here's the situation. And by the way, this is mind-blowing. The investor put up 100% of the capital and assumed 100% of the risk, but collected only 53% of the profit. The mutual fund management and distribution system put up 0% of the capital and assumed 0% of the risk, but collected 47% of the return. Almost half of the profit was siphoned away by those who had everything to gain, but nothing to lose. Don't take my word for it. Ask Warren Buffett. Ask his mentor, Benjamin Graham. Ask Jack Meyer, the remarkably successful wizard who tripled the Harvard Endowment Fund from $8 billion to $27 billion. Here's what he had to say. Quote, "Most investors think they can find managers who can outperform, but most people are wrong. I will say that 85% to 90% of managers fail to match their benchmarks. Why? because managers have fees and incur transaction costs. And in the aggregate, they are deleting value. The all-market index fund or the S&P 500 index fund is a far better way to invest than searching through a seemingly endless list of the products of the marketing-driven, asset-gathering machine that characterizes today's mutual fund industry. Other types of equity funds may approach that simple ideal, and certainly some few will surpass it. But the odds of success, as I've shown you this evening, are terrible. If that's not enough, ask any economist who's won the Nobel Prize. And if that's not enough, just use your common sense to think through what I've just said. Successful investing is pretty simple. Just do a few simple things right and avoid making stupid mistakes. So let me close with 3 rules you should follow, whatever strategy you pursue. First, in investing, realize that you get what you don't pay for. Whatever future returns the markets are generous enough to deliver, few investors will succeed in capturing 100% of those returns, simply because of the high costs of investing. All those commissions, management fees, investment expenses, yes, even taxes. So pare them to the bone. Second, don't do something. Just stand there. Own American business, not one company or industry, but a broadly diversified portfolio of lots of companies and industries. Buy such a portfolio, never sell, and hold it forever. Third, stay the course. Invest for the long term, decades, even a lifetime, and start as soon as you can. No one knows what stocks will do tomorrow, or even what they'll do over the next few decades. But over the long pull, the dividends and earnings growth of American business will be reflected in rising stock prices. Finally, the stupid mistakes. What are they? Thinking that you know more than the market does, investing on impulse, buying on tips, believing that past success repeats itself in the future, letting your emotions overwhelm your reason, and for that matter, ignoring the advice I've given you this evening. And then he took the microphone and just spiked it down like a football and said, "Bogle, out." This has been Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.